It's so much easier to build in a country that already the populace understands credit, where you don't have to teach them about credit, as opposed to a country that doesn't. That's why in Brazil, for example, Nubank was able to scale so quickly, because it was a already understanding of what credit is and giving a product that was right for the consumer, but the switch happened, right?
What is money? How does finance change? What is the future of money and finance in the future? These are some of the topics we're going to be discussing, Gaurav and myself. And if you don't know what FUMO is short for Future of Money. It's our newly branded or rebranded podcast, but we've been doing this for a couple of years.
Yeah, I think it's episode late 80s. Like it's wow. So many, and having so much fun doing it. We don't even keep track of the number, but it'll be listed.
It's been a lot of episodes, and way back in time when we started this podcast, one of our first guests was our dear friend Omair. And welcome back, Omair. You have been a friend, a client, and investee, I guess we could say.
Something like that. Portco, they call them, right?
Portcos.
Yeah.
Oh, yeah. You've got so many. You've got a portfolio. I just have a few.
Don't you start.
I have a few angel or fallen angel investments.
You've got angels.
Fallen angels. Oh. You've got a obviously not this one. This is a soaring.
This is a star.
Yeah. Soaring. So what we're going to be talking about today is, well, hopefully this can all be edited out. What we're going to be talking about today is, what does money look like in the future, and how does fintech change? And Omair is going to basically help run us through that. Before we get into the content today, just a shout out to our sponsors and producers. FUMO is, as you know, produced by CFT EdTech out of London. It's sponsored and backed by XVC Tech, an investor in innovative tech based out of Dubai that invests globally. And ecosystem partner is MFTA, the MENA FinTech Association. So thank you to all our sponsors and backers. Omair, welcome back.
Thanks for having me on again.
Yeah, it's been a minute. It's been a minute.
Apparently that's the saying now. I have only just picked up on that.
People looked at COVID and said COVID didn't count for timelines. And since COVID and funding winter, people have pretty much adapted. It's been a minute. It's been a minute. Good to have you back.
Thanks for having me on.
So, Omair, you feature in the book I've got coming out. And it's all about how credit in emerging markets is a big problem. There's this big gap of credit. And when we go to somewhere like America, where you used to work in New York when you were a client of mine back in the day, when you were on Wall Street, credit's not really a problem. I mean, there are issues about pricing of credit and, the rate of credit. And there are some, obviously, bad cases of people not getting credit or being denied access depending on postcode and zip code and so on. But generally, the amount of credit there is in a market like the US or the UK, that's not really an issue. But we go to countries like Pakistan, where ABHI operates, or Egypt or Nigeria, credit's a big problem. There's just not enough credit. And I'd love to sort of get into that topic in a bit more detail. Like, when you were building ABHI, you were thinking about what does, why did you start with credit? What was that gap you were filling? Why didn't you do payments or something like that? Why credit rather than payments?
So one thing that I had as a thesis as an investor and now as an operator is that credit is really what is going to allow for digitalization to happen across EM. Why I say that is because, I think I said this before, cash is actually the most frictionless. You can go to Pakistan, even India today. I mean, post demonetization is a great chart saying, yes, digital picked up, but cash actually started picking up just as quickly right after demon. And so the point is, on the street, people are very happy using cash. They really don't need to pay digitally. Digitally works for inclusion perspectives, for then underwriting to happen from a overall government perspective. and top-down perspective. But from a bottom-up perspective, digital doesn't really, no one cares. No one cares. So how do you get people on? Now, when I say credit first, and if you look at payments companies, for example, they also use credit. It's just that it was called coupons instead. So here, download my wallet, please. And if you use my wallet, I'll give you 20% off at Burger King.
Yeah.
That's credit. It's just a different way of providing credit. And the moment you take off that incentive, the switching costs were super low and people fell off your platform. Like, okay, cool. I had that wallet for a little bit. I'm now moving wallet. So the previous decade, I think, was the building of infrastructure.
Yeah.
So whether it be an M-Pesa in Kenya, whether it be UPI in India, Pix in Brazil, the infrastructure layer needed to be built. That's where money went in. And so it made sense to be a payments business at that point in time to be able to create the infrastructure.
Yeah.
Now,
so you're thinking about, this is like the 2000s, the early 2010s,
Exactly.
the M-Pesas, but also in places like China, Alipay emerges for e-commerce, PayPal, I guess. All the OGs that we know of fintech today.
Exactly.
I mean, they came out of that whole payment infrastructure.
100%.
Yeah.
And so you have to create that. They're always equated to the railroads.
Yeah.
Right? So the railroad in the US or even in the UK was there to create commerce on both ends of it. But the railroad itself was never the actual equity play. Right? What was the equity play? It was the Amtrak's.
Okay.
It was the businesses that built themselves on top of the rails,
Right.
branding on top of the rails that provided a product and service that the people needed. That's where the equity
Or
value
at the
is
end
built.
of the rails, the
So if you didn't have the rail,
property, the real estate at the end of the rails, or at the stations.
So as a country, if you do not focus on let's break down fintech.
Yeah, let's do it.
Fintech.
Let's do it. This is good. Let's do it.
So democratization of fintech has to be free flow of money from an NDR perspective.
Yep.
Why did UPI kill payments companies in India?
Yeah.
Because, and before there was no connectivity between 2 points. So you said, well, guess what? I've got a closed loop that I can connect from me to Gaurav, and I'm going to charge you. And
Basically a private road.
It's a private railway.
Yeah, private railway. Yeah.
Private railway. But if you want, as a country, to be able to really allow leverage to come into the system and for GDP growth to happen, you need the entire country connected.
Yeah.
So that the rails, the payment systems should always be a commoditized product.
Yeah.
Now, it's great. People have to build it and there's money to be made at that point in time.
Yeah.
But from a compounding equity standpoint, the rails are never, and the payments business is never where you want to be. QED says this well, which is a fantastic investor in the fintech space.
Yeah. What did
All roads lead to lending
All roads lead to
when
lending.
it comes to fintech.
All payment companies are unborn credit companies.
Exactly.
Pretty much is the point. And I agree, the real estate is the play. I mean,
Go on.
looking McDonald's, real estate was how he secured the business, really, from a fundamental point of view, because essentially it was what was lending to the business to make sure that he could offset franchise money. He got real estate money, not just sales, right? It happens in the malls here. We know that, right? It's a mix of real estate plus a mix of sales. There's always a duality, but if you own that real estate, infrastructure, for lack of another word. Same with railways, same with petrol stations. It's always about the real estate. That asset book through is just a conduit. But building it took time, right?
Exactly. And you need people to do that. And that's great. And that's required. And eventually the government will support you as a business to be able to do that. But to then go out and say, I'm going to it's like going out and rebuilding the internet today, or as Internet 1.0, right? Doesn't make sense.
So you're saying, look, the analogy is it's either Fintech 1.0 is like railways, I build a payment layer, Fintech, I'm going to say 2.0, but where you want to build is like the app layer.
Exactly. And that's where credit's required.
Yeah.
And hence, so to go back to your question, why I went credit first is because that is what really entices you. You go to emerging markets, what does the people want?
Yeah.
They need more money.
They need money. They need money. Yeah.
They need money.
They need money. Yeah. They need credit.
So they're not saying, oh, I really need an easier way to pay my utility bill. That's a nice to have.
Yeah.
Beautiful. It's great.
Yeah.
It's cute. We have that as well. Fantastic. But I don't have money to pay my utility bill.
Yeah.
How can you help me there?
Yeah.
How do you underwrite differently versus the traditional banking system
Yeah.
that has left me out of the layer of credit
Yeah.
that not everyone else, but a few people have access to.
Yeah.
That's where the problem lies. So when you give someone credit for the first time, so the two reasons for it. For one is, I believe that's the fundamental problem in EM, in the smaller EM, is credit, right? So that's what people want. So solve for that. That's one. Two, the moment you're the first person to provide a person who has never been able to access formal credit, credit for the first time, guess what? They're a customer for life.
Right.
The loyalty factor that you have with that customer, where you help someone out that no one else was except for loan sharks, etc. There's a huge amount of loyalty that's built. So your ability to build a business with a loyal customer base and then cross-sell and bring them up the ladder is so important.
I think he has to be a bit careful. He's humanizing fintech.
It's funny you say that, and what I tell all investors, one that you'll see, we've also added layers. We've not saying pivot's the wrong word. We have different business lines now, and I said from the beginning, if in 5 years' time, 6 years' time, whatever it may be, the customer that came on to use earned wage access or invoice factoring, for example, at the beginning on the SME side, if they're still using that same product, I would have failed as a company.
What do you think? A good time to talking about the product a little bit, maybe? Go into that side. He's opened up the door a little bit for us to go in. How do you feel?
Why don't we just kind of hit pause and then dive into kind of a couple of educational snippets, because you've just mentioned a couple of terms there that we all know.
Yes.
Earned wage access, EWA, invoice factoring. But for the audience, some of them, maybe a couple only, but won't know what EWA is. Give us like the snippets of what EWA is, invoice factoring is the product. Then you maybe we can dive into the product build.
You think right time?
Yeah, let's do it.
Okay.
So why don't you give us the definitions of?
Cool. So EWA, very simple. Earned wage access is the full version of it. It's exactly that.
Okay.
So think of it as, I would say the current way of wages globally, apart from the US, which is biweekly, you as an employee are essentially lending money to your company for a month until they pay you. So why does that make sense? If I work today, why don't I get paid today? In fact, the world has gone in reverse. If you go back to initial commerce, during the Roman Empire, it said you're worth your salt. So they'd come to you and say, okay, what did you work today? And they just pay you in salt for the day. Over time, from a working capital perspective, become much more efficient for companies to elongate that.
You're becoming an unsecured creditor of your company.
Exactly. So our whole thing is, let's flip that on its head. So earned wage access is exactly that. You work today, you deserve to be paid today. And so we come in from a B2B2C perspective, so through the business to the employee saying, I know your HR records, I know how much you've worked. You log on the app, you'll say, okay, this is how much money I've earned today. Click of a button, boom, you can access it. Simple. So that's the earned wage access side. SME working capital financing is our other side of the business, or is to the business. And that is invoice factoring, which is very simple. So SMEs make up predominant part of GDP across emerging markets. But yet, in emerging markets specifically, there's next to no credit for them. Now, what's the biggest problem that SMEs have? They typically are supply chain. They work towards their customers are large companies. Company says, let's give an example. I am a bottle producer and my customer is Coke. Coke says, I need $100,000 worth of bottles. Or whatever, how many units. Says, yes, I'll make it. I deliver it. Coke says, thank you very much. Love the product. I'll pay you in 90 days. What? Hold on a second. I've just taken my cash. I've made it. I've delivered it. And then you're going to pay 9 days after that?
That's what they pay on time.
Exactly. So that causes huge working capital issues for businesses. So what is invoice factoring? It's exactly that. You'll come on our platform. You say, hey, look, Coke is a customer of mine. They say they're going to pay me in 90 days. I need working capital because I want to grow my top line, grow my business. I'm not able, this actually stems into the EWA aspect. I pay my employees late. I'm not being paid on time. So how can we fix that? That is through invoice factoring, revenue-based financing. These are the areas where we step in and say, look, you as an SME, no one cares about you. We'll be there for you.
Yeah.
So those are the two.
They're both somewhat similar, right?
Yeah.
I'm an employee. I've given you my labor, given you a service. I'm getting paid a month later. I'm a small business person. I've given you my product. I'm getting paid 3 months later. And it's just this gap,
Exactly.
a cash flow gap you're bridging. Let's unpack building. Before we went live, we were joking about how there's the idea, but everything is execution.
Yeah.
And it's a cliche now, but
So
it's
true.
execution. Gaurav, you know more about execution than me.
Unfortunately, I do. I mean, so, the last time we saw you was the earlier stage of the business. I think you look at anything in this space, you identify the problem, you have good data on it, but then you actually start doing the business. And then you start touching parts of this human element of fintech, which is customers and people. So the last time we spoke to you, you had started on your journey quite well. And when we look at that today, from what you started with and what you're doing right now, in terms of product, can you tell us how that changed or what that looks like? Because I know there's certain elements of the business we'll get into later, but just from a product approach point of view, you started the business, you started with one product, which is Urge Main Access. How's it looking today? Have you done multiple products based on that? Have you done multiple products based on the classification within those companies or employee types? What is it looking like today?
Yeah. So it's definitely layered and bifurcated as well. I think when you're absolutely right. When we started the company, it was earned wage access was our hook, our ability to show execution. I think that's really important when you start companies. It has to be complete focus. Can you actually go and build what you said you would? Now you could pivot, and it may not. EWA could have failed, and I would have to do something else. But point is, focus on that one thing, get it right, or fail and do something else, and get that right before you do anything else. And that was the focus at the beginning. But very quickly thereafter, what we saw was there were so many different aspects that were required, not only from the individual that was using earned wage access, but also the business that we were going through. And our whole thing was always, and we still remain, a B to B to C business, so that we completely close loop and allows us to kind of create a friction for us to build the company even further. When we started building further, we saw two things happening. One, the employee. We said, look, they're taking the money out. So average time spent on an app was 18 seconds, right? And unlike most apps where everyone's trying to increase the amount of time spent on the app, we were actually trying to do the opposite. I remember we were at 30 seconds at first. I said, no, how do we get it slower? Because when you get people money like this, Abhikaro, like that's literally our whole point, which means to take now, do it now. We want to get it to them as quick as possible. But you're taking the money out, and what was happening is they were taking out from an ATM, or if they had a digital account, most of them didn't. Then they were going and using that for something else. So I said, hold on a second. Why are we letting them even go? Why should they have to go and then create that as a process, put that all within? So, for example, I said, yes, utility bill payments. We put that in. You're taking your money out to pay your bills. What are those bills? We put that within the system. So you don't need to leave our ecosystem. You now need other forms of credit. For example, we now, your salary detailed. What are you taking the money out? Are you doing that for installments? Oh, well, we're closed loop now within our app. Why don't we give you a BNPL service? But a real BNPL service that is not buy now, pay never. It's actually buy now, pay later. Because I am direct debiting from your salary at the end of every month. And you need, for example, a smartphone. No problem. I can give you access to that. Salary insurance. So majority of our users are blue and gray collar workers. They have never touched an insurance product in their life. What do? We tie up with an insurance provider and say, if you lose your job, no questions asked, you get 4 months salary paid to you.
Wow.
Right? So elements of these are what we added on the B2C side of saying, let's layer the products, cross-sell, allow them to be more than just earned wage access and use that as the hook to be able to go into something else. So that's on that side. Next was on the business. And the reason why we ended up going into the B2B side earlier than I thought we always wanted to, was it was the businesses coming to us and saying, look, this is a cute product, but we have a huge problem with our working capital, which is why we are paying our people late. How do you help us? So it became a go-to-market problem for us, to be honest, where businesses, SMEs make up majority of the economy, are the largest employers in the economy as well. Let's be very frank, in emerging markets, CSR and all that within SMEs, pretty low. So the CFO, et cetera, be like, love the product. I really don't care that much about my employee base. How do you help me? And then I'll help you. So we said, okay, it makes sense. I understand. Allows us to wedge ourselves in business. And to be honest, that's where it became more of an embedded finance platform for the business. Because that, when you are tied in to the CFO function, the ability for them to switch away from you becomes a lot tougher. And so that was something which was very important for us, saying we need to help the business because without that, they can switch away very quickly. And so that's where we launched into the working capital side of the business. And that's where we added on invoice factoring, revenue-based financing, working with online merchants who no one knows, but not that they don't know, but they haven't been able to underwrite the data that they have to be able to provide them with working capital solutions. So those are the different layers that we have as of now.
I know you're building product, you're learning at the same time.
Yeah.
You're building a business. This is not a charity as far as I know, right? You have to make money, scale, return to investors. And in the venture capital space, the return and justification for locking up capital for an extended period of time versus having in the bank for 3 months, 6 months, and bond product, whatever it is people are expecting much higher returns, high risk, high reward, right? We know that as well. In your space, you're a first-time founder moving into this space where you're developing products, learning, executing, and building a team. We won't even touch on geography just yet. We'll go to that at another point. But now you're servicing products with 2 people. How are you finding this from an investor conversation? When you engage with investors, we've talked about, in the markets recently, funding winters. There's more of a stress on profitability. You're doing this discovery. You're building product for one segment. Suddenly you're building a product for another segment, which is in the same ecosystem, to be fair. But you've got to raise capital to build, fit, deploy. Tell us more about how that journey has looked from building the business, funding linked to this pivot, and taking that business to another level. Are you profitable now? Is it something which fell into your lap? Were you fortunate? Tell us about the team as well. So team, product, funding. Can you give us more insight on that aspect of your journey?
Absolutely. My co-founder Ali and I, from day one, before even saying, let's go and do this, we made it clear that our mission was to become default alive as soon as possible. So,
and what does that mean?
And that means that if we were not able to raise any more funding, the company should still be alive. Because we did not believe in the burn approach of building a company.
What?
Now, so a couple of reasons. PTSD from having been an emerging market investor for over 15 years and seeing liquidity cycles being very short. So if you build with the mantra of thinking you are living in the valley or the US, but you live in Pakistan, Dubai, India, Nigeria, you are doing yourself a disservice. You're doing your investors a disservice. You're doing your employees a disservice and your customer a disservice because you need to deal with the hand that is dealt with you, not the hand that you wish you had.
Sure.
And so our focus was that we know liquidity cycles are short. Therefore, we're here to build a business that is everlasting. We should not be in a position where when people turn around and say, guess what? We don't like Pakistan anymore.
That never happens.
No, never.
Never. Never. Of course.
No, Fintech. I don't know.
Credit Fintech in Pakistan.
No, I mean.
Hottest thing ever, right? Everything's
fine.
Everything's fine.
We needed to make sure that we could.
Only 2 years ago, it literally was the hottest thing ever, right?
100%.
We had to beg to, invest in these companies.
We had to beg to invest in.
And it's like the biggest thing ever.
This conversation we're having, in terms of this turn. Didn't happen 2 years later. It happened 12 months ago. So it happened in 1 year, not 2 years.
Yeah.
We're having this conversation.
I know.
2 years.
So cycles. They're cycles. And we used to joke about this, right? Because obviously we've all seen
Volatility.
living, you know, in these countries, but also investing and analyzing these company cycles. And you would have investors, like we used to, you know, you told me you'd have investors showing up, and obviously you were initially and you're much more now, but you're initially a Pakistan-focused business, and they would probably know nothing about the macro in Pakistan. It was the same in Egypt and Nigeria 2 years ago, 3 years ago. And, you know, it was just like, they were literally like, yeah, in the valley, we just invest in product.
Yeah.
We need to think about macro. Who's running the country or currencies, stuff like that.
I remember we were talking about a funding round, one of his funding rounds. We won't name which one or everything else. And we having a conversation. He goes, timeline is this, this. I'm like, lock it in. I was like, lock it in now because you can push everyone away later. So, so it's exactly what he's talking about.
So was it default alive or default?
Default alive.
Default alive, So, sorry, I interrupt. Carry on that train of thought.
So with that in mind, we always made sure that the unit economics made sense for everything we launched. We never sold $100 to $90.
Right.
That's something we said fundamentally we will not do.
Right.
And there was a period of time where we were very unfavorable for that. We could have probably grown faster, raised maybe 10 times more, taken on a different set of investors who had them. I remember one specific investor, very large, out of Asia, that literally after a 30-minute call sent a term sheet into our inbox, and 10 minutes after the call said, we need to close this tomorrow. We love your company. And the KPI was you need to burn $750,000 a month.
Right.
And I was like, why?
How big a company were you at that stage?
Oh, we're tiny. We just closed our seed round.
Oh my.
We used $2 in our seed round.
But this is when things were on the up,
yeah,
right?
things were on the
People
up.
wanted access.
Exactly. They said, no.
Cash was easy.
Exactly. They said, no, you burn. You need to burn because don't worry. When you burn that,
We got your back.
we'll come for your next round. We're going to price that up because we got this growth fund. So then I thought, sorry, we're going to say no.
Because for them to pull back afterwards and just leave you there,
Which very much happened.
is almost guaranteed.
Because I know people who took their money, and then when the world changed, they went back and said, hey, we hit the KPIs you asked us to. It's like, where's your profit?
But exactly.
I mean, one result of this was SPACs, right? Trying to spin out to liquidate companies, PRPO. And now that that's not happening, investors are pushing for secondaries, right? Exactly. Secondary funds. So suddenly all these joyous things are happening without people calling it M&A or other things. So it's a tough journey that distracts founders from delivering a service in a longer term fashion.
So a couple of themes keep coming out of this conversation about, so there is importance of building for the local market. It's not copy paste. Copy paste, it just doesn't work. So, it makes sense to build credit or lending businesses because that's where the gap is. It makes sense to have investors that understand your product. We talk about this, actually, the opening chapter of the book where we feature you, we talk about the restaurant scene. We're sitting with
David,
our common friend, Dave Nangle, in New York, and discussing whether or not you should build a business in Pakistan. And Dave goes, never invested in Pakistan, but hey, I know you, so we should do it. What are you going to do? And then you go away and, we talked about it in the earlier podcast as well. You go and did your business plan over the weekend. And then one of the things you said to us in the past, and I don't know who's come up with this originally. I mean, this phrase about emerging market investing is like time travel. Or you could say the same thing about emerging market operating. And, in your previous role, you went and saw lots and lots of countries, right? And there is this, I think it's very evocative. It's time travel because you can go to Indonesia or India and say, okay, that's happening. I could do that maybe in Egypt or Pakistan. Just delve into that concept a bit more for us. So either as an investor, but maybe even more as an operator. And I'm sure you've got questions about expanding ABHI into multiple countries.
Absolutely.
So just what did you mean when we were first talking about it's time travel?
So this goes, it's a twofold answer. What I meant by time travel was, I remember when on the investor side, as you already said, I'd go to places like Ethiopia. And what was innovation in Ethiopia for finance was very different from my next trip where I went to China,
Right.
for example.
Yeah.
And you can be very caught up with trying to do copy-paste in geographies
Yeah.
when that market is not even ready for that yet because the basic building blocks aren't there for them to be able. If you took product from China and took that into Ethiopia, for example, and the more sophisticated areas, it just wouldn't work.
Yeah.
Because, and you'd probably raise money for it.
Yeah.
It sounds great. And something I've never been to Ethiopia, probably like, that sounds good, throw some money. But you'll never get product market fit because the market's just not ready for it.
Sure.
I think, actually, let's rewind. Before I launched the company, David, after that meal, said, please go to Brazil.
Yeah.
And I was going to Brazil anyway.
Yeah.
And sit with Sergio.
Sergio is
Creditas.
Sergio Furio.
Exactly. So he's a founder,
Creditas.
co-founder of Creditas. Amazing company, amazing founder. And I caught up with him and I told him the idea. And he said, Omair, love the idea.
Yeah.
Are you sure Pakistan is ready? I was like, what do you mean?
How dare you?
I'm ready to go. This is 2018.
Ready for what?
Exactly. And so
It's a big question.
he said, is Pakistan ready for digital lending fintech?
Okay.
Right?
Okay.
And I'm like, what do you mean? He said, look, I've been down your journey. What your journey is going to be.
Yeah.
I left investment banking.
Yeah.
He moved from Europe to Brazil, never having lived in Brazil before. I was doing New York to Pakistan.
There's a wonderful intermediate step, right? When
Yeah.
he's in New York and he meets his wife,
Exactly.
at the time girlfriend, and she tells him about Brazil, and he goes,
Exactly.
I'm going to go to your home country and build a fintech.
Exactly.
And that's a great chat-up line. It worked. I mean, he created a unicorn and
He delivered.
got a wife.
It's
I mean,
almost a decacorn.
a decacorn and a wife. Did you, was there something similar? Because you went to your wife's country and decided, to build up.
Exactly. So it's
Parallels.
very, everyone else, North Star for me is Creditas. Even though our businesses are very different, just from what he has been able to do, it's phenomenal. And his point was that he said, Omair, when I came and I was like, I'm here.
Yes.
Fintech, Brazil.
Yeah.
Like, it took me 4 years before we actually saw decent transactions.
The spark,
The
sort
spark.
of the flame.
4 years to get traction.
And he said
Any kind of
Brazil was not ready.
And this was 2010, 11?
Yeah, around then, I'm guessing.
Brazil wasn't ready.
He said Brazil was not ready for what I had to offer. And he's like,
And
we didn't. He's like,
in that 5 years, do you know that made it ready? Or?
one, I think there was. I mean, Pix came around. You had other digital lenders, and also the credit system came through. New bank was born.
That's exactly what we talked about a little bit, right? The infra, right?
The infra was
right. The infra.
So
there were a lot of new players emerging as well, like Nubank.
exactly.
Yeah.
And so he said He said we didn't burn a lot of money, by the way, but it was a pay for 4 years. Imagine going to an office every day, and there's nothing covering. Like no one.
Yeah, and you
he's
from an investment banking consulting world.
Exactly.
Yeah.
So he said, "Are you sure?" So this is 2018.
Are you sure?
Are you sure? I was like, "You're right. I don't know if Pakistan's ready yet." But when
So how did you make yourself sure?
at that point I wasn't sure, right?
weren't
And I said, "You're absolutely right. I don't know if Pakistan's ready yet because there are some players there, but the traction is just not really great. So that's usually a sign."
Yeah.
But then when COVID happened,
That's
when I said, okay, this is where digital adoption has to happen. So to answer your question in terms of time travel, that's where it's important.
Yeah.
Understand countries where they are in their evolution.
Yeah.
But then when you do invest in that company, know the pattern recognition you can show and milestones that the country from a top-down perspective, infrastructure perspective, need to hit for that company to do well.
Yeah.
And so that was key for me now as well as an operator of building for your local country and what is the country need at that point in time versus what you think they need 10 years from now.
It's clearly a glutton for punishment because he's not doing it in one country, he's doing it in multiple countries, right?
All really easy to operate in countries, right? Super easy.
Right.
Like it's as easy as operating in the valley, probably.
Right.
Yeah.
Oh, easy.
Very easy.
Like shooting fish in barrel.
Yeah.
And someone
totally.
that's been doing this for 20 years in about 15 countries,
Yeah.
this is sort of bringing back a little bit of trauma for me personally, in terms of this delivery channels. It's a very close echo. You know, before there was.
Is this going to become a free therapy session
for him? Yes, it is. I'm charging by the minute. You guys do that, right? Yeah. So same lending principles, just more micro. But you know, building a business across geography, delivering a product, right? This is not Twix or Mars or confectionery where it's a product and you're relying on, you know, just there's a stable market and you can produce it. This is almost like a franchise business, but every franchise, even say the restaurant business, is tweaked locally. When you do a McDonald's or a Din Tai Fung, there are certain products that in the local markets, they're catering to the local market and they discover what works, what doesn't work. Echoing that franchise, Din Tai Fung kind of McDonald's franchise business, they have the brand, they have ownership, they know what works, but they discover what works in those geographies. Tell us more about that part of your journey, going from a market which you developed further in product, and now you're moving to different markets. Tell us about the geographies you're going into, and is it copy-paste, or is it Din Tai Fung, I'm taking products off the table, things like that in those local ecosystems?
Yeah, no, localization is something we very much focus on. There are aspects of copy paste that can happen depending on the target segment you're going with. So what you have to be very careful of. So for example, UAE to Pakistan, Pakistan to UAE, the other way around. In Pakistan, a white collar and blue collar worker will use our product.
Yeah.
Right? Majority blue and gray collar, but white collar worker will also use our product.
Really?
Because just penetration of credit cards in the country is so low.
I mean, credit cards, like once you get outside the super elite, it's like...
It still doesn't seem so obvious just yet.
No, it's like, it's tiny, right? The percentage penetration is tiny. For cards and
tiny.
Wow. It's just all your friends have, you know.
You're my friend.
No, one's in Pakistan. Here, everyone has credit cards.
I get rejected for credit cards.
This is that Spider-Man. This is that Spider-Man moment.
That's entrepreneurial, like
exactly. No one's willing to
underwrite you to have.
If you're listening,
is there
the number? Call this number here. Flashing.
Omair needs credit.
I'm not kidding. Actually, I applied for a credit card over here.
Yeah.
And the bank manager, not even manager, the relationship manager said, "Sir, this is your salary?" But I thought you were...
And you were joking when you said this is a therapy session. This is happening.
But you said you're a CEO and you... Sorry, I can't give you credit. I was like, Jesus, I mean, looked down by the teller on for getting credit card.
Anyways, back to... There was a question here somewhere.
Yeah, so that's Pakistan.
Pakistan.
Now, over here, and this is where second mover advantage always plays through versus first mover disadvantage. There was a competitor we had in the UAE market, which unfortunately is not there anymore. And what they did was they went after the white collar worker in the UAE. Now, as anyone who lives in the UAE knows, an average white collar worker has like 7 credit cards.
7?
If you are an EWA,
I have 1. I cut up the rest.
Exactly.
Right.
Anyone who's smart cuts them up, but otherwise, everyone takes us.
A good reminder. I have one I need to cut up. Yeah.
So
well, actually, not cut up, just delete the relationship. But that's another question. Yeah.
And so fundamentally, that's where we knew from not day one, but a few months into launching business in Pakistan. We said anyone who's a credit card customer and has a credit card is not our customer. Because
in the UAE,
anywhere in the world,
anywhere.
If you unless debt, so this is where it flips. In the US, for example, why EWA does very well is because of debt substitution. Because people are so indebted that they don't want to pay the APR of a credit card. They can substitute it with EWA.
Yeah.
So that's a big. So again, localization for that market very different. Over in the UAE. It's the white collar worker already has credit, so you're not my target market. So we said, okay, who is our target market? It's anyone earning less than 7,000 dirhams a month. So we honed in. And we said, this is the target market we need to go after. And that's why,
and industries is that? Or what kind of, these are like
manufacturing, construction, retail.
That company you talked about, without naming it, that has been bankrupt. I was trying to do M&A for you guys, right? We were trying to do it. But weren't they targeting the...
No.
They switched because their whole premise initially when they launched was to try and do this. But
exactly. And so when I saw the numbers and started talking about it, I said, sorry, it doesn't work.
Very
And so with us, within like 2 months of launch, for example, they were around for 4 years. We hit more in revenues and top line in 2 months of launch over here versus what they did in 4 years.
And that was about targeting the right
Targeting the right segment and knowing who wants your product. Who is your customer?
So was it an existing product ABHI already did, or was it?
It was EWA. It was purely EWA.
Yeah.
So what you had in your arsenal, you deployed it.
But knowing the right target.
Is there something different you're going to be doing in product here?
Yeah. So this aspect which we have added on, which we are working on, and luckily the tie-up with Visa Direct has helped us with this, is the remittance corridor.
Okay.
So why is it that the migrant worker, so a typical person who is earning less than 7,000 dirhams a month, what are they doing with that money? Again, it's always the question, what are you doing?
But Visa is going to put their branding on everything and hold you hostage, and all the rest of it, right? Because you can use anybody. You don't have to use Visa.
Of course.
Hopefully you get some benefit of using the Visa network. Because Visa, again, right, is the rails and that infrastructure to a large degree globally, which we need access to. So that's the other thing you're doing. Is there something else on the corporate side, the B2B side also that you're doing?
So on the B2B side as well, look, that's one nuance which is exactly the same as in all emerging markets, is the SME financing aspect of it, working capital, invoice factoring, revenue-based finance. That's something that just is still lacking over here. So that's where we're seeing a lot of traction, but the nuances are slightly different comparatively to Pakistan in terms of the kind of businesses they are, who the supply chain is, who the customer is. So that's one aspect of it. But the also other aspect, which is different from Pakistan, is some of that is not local only, it's international. So it goes into an element of trade finance.
Right. Yeah, this is such
because this is an international hub.
So it's almost like he's walking through product discovery a little bit as he's going along.
Exactly.
That's interesting. Okay.
So
should we, sorry, Button, should we focus on Bangladesh a little bit as well?
We talked
about Pakistan and the UAE. Just conscious of time. Talk us through, why did you pick Bangladesh as a market to get into, and the sort of the journey in practice, how that unfolded? Because I'm sure we can come up with lots of kind of, smart, I was going to say smart McKinsey top-down studies on why he went to Bangladesh, but there's probably like a girlfriend or something, or I don't know, a friend, or probably, yeah.
So Bangladesh was always a market I wanted to go and set up in. And
why?
It's the pioneer of microfinance.
Yep.
So absolutely. So you look at Grameen Bank, what Yunus was able to do there. You look at Bcash in terms of an infrastructure play. It's there.
Yeah.
They are the infrastructure.
Melinda Gates Foundation has been involved in that for the last 10 years.
Exactly. And so that, for me, had all the right elements of just a population that understands credit. So this is one thing which is really important, having gone through the journey, and I was talking to Dave about this. It's so much easier to build in a country that already the populace understands credit, where you don't have to teach them about credit, as opposed to a country that doesn't. That's why in Brazil, for example, Nubank was able to scale so quickly, because it was a already understanding of what credit is, and giving a product that was right for the consumer, but the switch happened, right? So able to build volume very, very quickly. The biggest part of what we do in somewhere like a Pakistan, for example, where you have GDP per capita at a certain level, where literacy rates at a certain level, is you are educating the user of what is credit, because they've never touched formal credit in their life. They think of it as black magic.
So you're pushing product to people as opposed to them consuming and pulling it in a market that's educated on. Okay.
They think of credit as black magic in Pakistan because they've never had it. Most of them from traditional channels.
Also, right?
Exactly.
Yeah.
If I see somebody else that's leased a car, and I feel like the bank is collateralizing something where they, create a scenario where they'll take another asset away or do something else. If everything's fine after 2 years, I trust I seen.
Whereas in Bangladesh, it wasn't seen as black.
It wasn't, because I think the learning curve that happened for them to get out of the typical mentality of credit is bad happened with Grameen, etc. before.
Right.
So, so those nuances, and the third aspect of it was in terms of concentration. So one thing which is really interesting about Bangladesh is it's really a tale of two cities. So Bangladesh, big country, over 170 odd million people, but over 85% live in two cities, which is Chittagong and Dhaka.
85%.
Well, you look at Pakistan,
Yeah.
230 odd million people. Yeah, there's KLI, Karachi, or Islamabad, but then everything else is very dispersed.
Right.
So your ability to be able to capture that TAM is much harder than a place like Bangladesh. And this is actually, you can just see it from public market numbers. So go just look at Marico, Bangladesh, which is publicly listed, versus Marico, India, which is obviously listed in India. The operating margins of Marico, Bangladesh are significantly higher. Why? Because they don't need to spend as much on distribution and marketing as what India does. Because from a distribution perspective, one, it's only basically two cities they need to capture. From a marketing perspective, they actually just borrow on what ZTV, et cetera, happens up north, which basically allows for, which allows for the Bangladeshis to be able to see that same advertising. So similar story when it comes to for this. For me, it's that this is a one large market.
Concentrated market.
There's education levels which fit for our product that we like. And overall, early in the journey, I like being in places before others realize what it is. And so that's where I find Bangladesh super interesting. You look at it as well, just again, macro perspective, GDP per capita has doubled and is actually higher than India now over the last decade.
But you look at all of this, right? There's a bit of the other side of the coin as well, right? One's not far away from the other. And what I mean by that is in a developed ecosystem, you've got good data, compounded in two areas, infrastructure is there, education is there. Can't be that you're the only one that's seeing this, right? There's got to be just as easy capability for competition that is your immediate rival or incumbents to service the market as well in all these areas. Particularly in Bangladesh, this competition seems to be there. But you had competition in the UAE, I understood they were not targeting perhaps the correct people where you saw traction earlier than them. Are you seeing that in Bangladesh as well?
In terms of competition?
Traction and competition, because we have competition will always be there, but the infrastructure availability, educational market, perhaps the parameters to accelerate that on an even higher level of intensity in Bangladesh is more competitive and tougher than in Pakistan and UAE.
Definitely. So it is. In Bangladesh, we have a competitor which is very good. However, my view is there's enough room for 6 players to be in that market.
Oh, wow. Okay.
At the same time, we're not playing to be number 2. And our focus in Bangladesh, and this is again goes into the localization. We did not go there organically. And I believe even in our future as well, we will not enter new markets which are similar to a Bangladesh, which is your Egypt, etc. We will never step into these markets organically, because if you are not local and you do not have that local expertise and that local capability of execution, you will die. You will spend as much money as you want. And large companies have made this failure as well, by the way. Amazon, for example. Amazon tried to step into Brazil many times, failed every single time. Amazon has tried to step into India as well, failed. Had to do it inorganically eventually. Netflix, similar. So the point is that you have to go in and make sure you localize as much as possible. We don't use ABHI branding, for example, in Bangladesh.
What do you call them?
Mitra.
And that means?
And Mitra means friend.
Friend.
And that is, we have a full, the team there is so Kishore, for example, who's the CEO and co-founder of the business. He is an amazing execution person. He is local. He built the business from scratch. We got introduced to him very early in his journey. The world changed, and we were lucky to be able to back them. And I said, look, let's give you the firepower. Let's give you the infrastructure for you to go and build. And so for us, that was key. In each of the markets, have people that execute and understand the local nuances, because if you don't have that understanding, you'll be eaten alive.
Local. We're running out of time. So maybe one last set of questions around the future of finance, the future of fintech, and the future of ABHI.
Right.
Yeah.
I mean, it's super interesting. You want to take it away?
I'll start, and then maybe you can bring it home.
You got it.
We've talked in this, what has it been, 40, 50 minutes, something like that conversation about the journey of fintech and financial services. Money used to be coins, then became notes, then credit cards and plastic, and then jumping over a few steps, and then we got into digital and mobile phones and payment and then credit. Where do we go next in this fintech journey? Like, what's if you had to crystal ball gaze and you were thinking about building something in 5 or 10 years' time, what does fintech look like? And of course, we've just talked about time travel. So it'll be different in different countries.
Yeah.
It'll be different if you're building in the US to Brazil to India to Pakistan. But with that caveat of local regional differences, what does fintech look like in 5 or 10 years' time? Just like Alipay dominated for me. And if I think about the fintech story of the last 10, 15 years, there are certain names that jump out, right? The Alipays of the world. You mentioned Nubank, and the neobank phase. I mean, they're like the category killer, the category definer in neobanks. Alipay for payments, M-Pesa, the OG. What does it look like in 5 or 10 years' time?
So, assuming everything's ubiquitous, meaning EM and DM look the same, because that's a huge point.
Yeah.
From a data perspective, infrastructure perspective, and that we're all at the even playing level. My view is that fintech will basically be a world of mass personalization.
Okay.
And what I mean by that is now everyone's on the grid. Right now, there's like EM, for example, you're trying to get people, like even the US and developed markets, you're still trying to get people on the grid by giving them product. Now I have so much data across the board on you, the credit that you have, the salary detail, the investments you make. I have data on all the different fund structures, real estate, tokenization. I imagine a world where I wake up and everything is being managed in the background for me. It says, hey, literally, it's a bot behind saying, you got $150 sitting in this account, which is yielding 2.6%. This fund is actually yielding 3.75%. We've already allocated over there, so you're automatically yielding more money off of it. Oh, based on your spending patterns, we know that you probably are going to need to get a loan for X. And by the way, we've already applied for it. This is pre-approved, blah, blah, blah. Just press yes, you're ready and go. It's almost like a personalized assistant for your finances, which would be fantastic. I think we were joking about it before, talking about your different bank accounts. You have to ledger it.
His different bank accounts.
And so why is that even a thing? Like this should all, at the moment, mass personalization,
intelligent financial agents.
That is the future. And that's the end of, then that's really branchless. Forget about it. What is the purpose of it? Because it should be all data driven. As long as I know your balances and what your expenditures patterns are, etc. I don't need to speak to anyone.
And it's very interesting. We're talking about the future, but in emerging markets, I still have a deep insight, or perhaps that I'm leaning on from my past, where we're talking about time travel to project about the future. And I think it's still going to come down to fundamentals. I think we talked about humanizing fintech, and what I mean by that is, if you build trust as a company, where your fundamentals are stable on profitability, building the business in the right way, in the right categories, not only are you building trust with the customer who's transacting with you for life, I think there are going to be elements where people are going to start asking you for more and depending you for more. You've got this wonderful phone that's a digital access tool that people use a certain percentage. They're not fully using it to the extent it can do for them just yet. But I think as ABHI goes out, my prediction for you personally is, what I see is, people will, as a business or as a consumer, start again presenting problems to you that using this data you've talked about to solve their fundamental problems bit by bit by bit until it compounds into something massive. And I think that's going to be super interesting to see. Then what does ABHI look like as a company? Are you a bank? Because people have asked you to become a bank.
Yeah.
Do you become an open API infrastructure platform because you've got so much data that it can impact foreign direct policy, it can affect fiscalization policy, it can do different things that help countries grow.
Yeah.
So they want access to that data. So you become effectively a bellwether for ecosystems where people say, oh, we've seen so much money going in and you can trust the economy because like Tala in Africa, the people there pay actually before it's due. People pay back their loans before they're due because they want to get good credit ratings for other elements to use it. So it's pretty interesting to see. Where do you see ABHI as a company? As
ABHI tomorrow.
Yeah. Yeah.
ABHI forever.
ABHI tomorrow.
ABHI tomorrow.
Yeah.
Yeah, look, I mean, for me, the grand vision is to be the one-stop shop across Frontier and EM as the credit platform for you to go to. And that's everything from Nigeria all the way to Bangladesh at the moment, 14, 15 odd countries, which will have cross-border remittance happening, cross-border underwriting capability, transferability of data, localization from a credit perspective. Everything will be credit-led, in my opinion. Ideally, over time, a lot of the balance sheet will move away from us. And so to answer your question, do we want to be a bank? Hell no. We don't want to be a bank. I think what ends up happening is the banks will end up continuously funding us because they will need a source of origination, and we will have the data to be able to provide the support for them to flow that capital through. You look at LendingTree, for example, the US always make a point. They have to be on balance sheet first before they went off balance sheet. We want to do something very similar. So I think at first we will be in that stage where everyone says, are you a bank? You're not a bank. You're a bank, you're not a bank. And I think some people will in between say, okay, these guys are a bank. But the ultimate goal is not to be a bank. The ultimate goal is just to be the layer, the tech layer in between that sources for origination, because we've been able to prove while being through our banking phase who it is that you need to be providing credit to, who should have access to it, and now you fund it.
So ABHI tomorrow is basically the customer interface layer, a tech layer, an information sort of depository, but not a financial balance sheet, not a bank. Let's catch up in 2 years' time.
Thanks so much for being here.
Thanks so much for having me.
Thanks, guys.
Yeah.
And that's a wrap.